Hello students, welcome back to my YouTube channel. Today I'm going to take the topic depreciation. Today it will be mainly concept clearing and some theory part of it for grade 11. And then in next class I'll be doing some problems, and then later on with provision for depreciation and other related topics. Now before I move to depreciation, about fixed assets. Fixed assets, what are fixed assets? They are the assets used in business for more than 1 year. They tend to lose their value while they are put in use. For example, machine is being constantly used every day for 7 to 8 hours or 10 to 12 hours, and there will be some wear and tear to it while usage. With when we bought it new, and after a couple of months it won't be same, or maybe after a couple of years it won't give the same kind of productivity. So they lose their value while they are put in use, and the value of fixed assets reduces with the wear and tear while it's being put in use. The value also reduces with the passage of time, even though assets were not being used. Even though the machine was kept idle, maybe it's rusted, maybe it's like some parts have broken, being kept idle, so still the value reduces. Also, with the passage of time, the asset becomes obsolete, with newer assets being bringing in better technology. And examples of depreciable assets are machines, plants, furnitures, buildings, computers, truck, vans, equipments, etc. Now, the fixed assets have these kind of when the firm is using it, while using these things happen to the machines or to the assets. Now, what is depreciation? Depreciation refers to decline on the value of asset due to any of the reason mentioned in the earlier slide, due to any of the reason mentioned in this slide. But before that, I just want to touch base on one thing. If you recall the expenditure are of two kinds. One is revenue, other is capital expenditure. Revenue expenditures are those expenditure which are recurring in nature, right? Which are recurring. For example, my rent, electricity, salaries, all these are recurring. They are occurring again and again every month, or fortnightly, or once in 3 months. They are of recurring nature. Whereas capital expenditure are it doesn't recur. For example, if the firm buys machine, right, worth rupees 25,000, so they are not going to buy machine every month. So this is a capital expenditure. That means this expenditure is occurred, and the company is going to get the benefit of it during the course of the coming years. And also one more thing you note, recurring expenditures are of lesser values, whereas capital expenditures are of more value. They are expensive. They attract higher amount of money. And the third point you have to keep in mind is capital expenditure. When we buy a machine, plant, equipment, they are going to be in the organization for more than a year. More than a year. We are going to touch base this topic later, but right now, to bring clarity of what is an asset. Asset is the money spent on procuring the capital for the business is called asset, which is intangible form. Machine, equipment, plants, land, all these things. Now, this is what we have done. This is what I've explained. Now, the third is depreciation. What is depreciation? It refers to decline. Now, here in the first slide, I showed you that due to wear and tear, the value of the asset reduces. So, the reduced value is called depreciation. So, decline on the value of asset due to any of the reasons mentioned in the earlier slide. The expired cost or the expense charged against the revenue of a given accounting period. It's a permanent Depreciation is a permanent, gradual and continuous reduction of the value of fixed assets. It keeps on reducing with the usage and passage of time. It is always calculated at the cost of asset and not at the market value. This you have to keep in mind. The amount with what I have bought, the firm has bought the asset for. It is an expired cost and hence must be deducted before calculating taxable profit. So in your profit and loss account, after you get the profit, so profit before depreciation and taxation, let's say, is rupees 50,000 and there is a depreciation of 10,000. So my profit before taxation will be calculated as profit before depreciation and tax less depreciation. So profit before tax is 40,000 and it is a non-cash expense. You will not see the movement of cash. It is charged on the, that's why we say it is charged on the asset. It is process of writing off of the capital expenditure, because any machinery which is bought in the organization does not remain throughout the life of the organization. The life of the machinery or plant or equipment is decided when we buy it, when the firm buys it, and that is how it's written off every year by calculating. There are different ways of calculation which we'll be dealing with. Let's take for example, a firm purchases machinery for rupees 1 lakh on 1st April 2010. Now it's estimated that this machine will work functionally well for 10 years and be productive enough. So we say estimated life of the machinery is 10 years. So what do they do? How is depreciation calculated? So you would say depreciation in this case would be the cost of the machinery is 1 lakh, right? 1 lakh is the cost of the machinery, but the firm is going to use it for 10 years. The whole 1 lakh rupees cannot be taken as an expenditure on the day it is bought, because it's a fixed asset, it's a capital expenditure. The revenue generated by this machinery would be spread in 10 years. That's why each year for the next coming 10 years, each year rupees 10,000 would be charged against this asset, and it will be taken in the profit and loss account debit side as an expenditure. So depreciation is always taken on the debit side of profit and loss account. The entries and all we'll be doing in the next video. So going forward, the next one. Now, what are the factors affecting the amount of depreciation? There are certain terms which we need to know. One is cost of the asset. What the cost of the asset is with the amount the asset is bought. Let's say the machine in this case was bought for 1 lakh rupees. Then that is the cost of the asset which the accountant or we should be knowing for charging the depreciation. So cost of the asset is, in this case, is rupees 1 lakh. It is not an expenditure, it is not a revenue expenditure, it is a capital expenditure, and it should be distributed equally in number of years the asset is estimated to survive. Now when we are buying asset, for example, the cost of the machinery, let's say cost of machinery at showroom would have been rupees 80,000, right? So we have spent, the firm has spent like carriage inwards, then installation cost, let's say registration cost. All these costs are pertaining to this, the machinery, the new machine which is bought in. So let's say all this cost together is 20,000 rupees. So we will say the cost of the machinery is rupees 1 lakh. This is not treated as a revenue expenditure. Carriage inwards, installation, registration, all these associated expenses for buying the machinery is taken as a capital expenditure and is added to the cost of the asset. So cost of the asset is not only 80,000, it is including the other expenses till the machine is put to use. Now let's go to the next one here. Estimated net residual value. What is residual value? Let's say after 10 years. After 10 years, now the cost of the machinery is 1 lakh, and after 10 years, if I sell it on scrap, it may go as a scrap, right? So the amount I would get, maybe let's say rupees 5,000. So this is the 5,000 is the residual value of the machinery. Let's say this is at the disposable time. So estimated net residual value is after you sell off the machine, what is the amount you're going to get, right? That is called residual value. Let's go further. Depreciable cost. Now what is depreciable cost? Depreciable cost is the amount at which it will be depreciated. Let's say if the cost of the machinery in this case is 1 lakh, right? And this is getting distributed for the 1 lakh, and let's say the residual value is, okay, here above we have seen that residual value is 5,000. So in this, the depreciable cost will be the cost of the machinery less net residual value, that is rupees 5,000. So depreciable cost will be 1 lakh, that is the cost of the machinery, minus the net residual value, or you can say the sale value. This will be the actual depreciable cost, 95,000 rupees. Okay, and this 95,000 will be distributed in 10 years. Let's go to the next one, estimated useful life. Now estimated useful life is, again, it's in the name itself states that the machine will be serving the firm for 10 years. So life of the machine is 10 years. So this is the useful life. 10 years it will be producing and give good productivity. So these are the terms which we should be knowing, and we are going to use it in while solving the problems. Now, method of calculating depreciation for grade 11, basically we have touched here two, straight line method and written down method. Okay, first I will take straight line method. Straight line method is very simple. In this, what happens? See, under this method, depreciation is charged at fixed percentage on the original cost. Please keep in mind, original cost of the value asset doesn't change throughout its estimated life. Under this method, the amount of depreciation is uniform from year to year. That is why this method is also known as fixed installment method or equal installment method. The annual amount of depreciation can be easily calculated by the formula. This is the formula we use to charge depreciation using straight line method. That is original cost minus estimated scrap value upon divided by estimated life. See, in this, we had the original cost here less the scrap value, and this is going to be 10 years, so I will divide by 10. I get rupees 9,500 is the amount to be depreciated every year. The machine will be charged with 9,500 rupees. So let's take an example here. A firm purchased a machinery for 2,20,000 on 1st April 2010. The expected life of this machine is 5 years. The point to be noted, the expected life is 5 years. The cost of the machinery is 2,20,000, and after 5 years the scrap of this machinery would realize 20,000. This is net realizable value. Under straight line method, how can we calculate? So we will write here original cost is rupees 2,20,000. Then the estimated life is 5 years. These are the points which we have to know. And then its realizable value, or you can say scrap value. Its realizable value is rupees 20,000. That means after 10 years, after 5 years, this will be sold off as scrap for 20,000. Now, how would you calculate the depreciation? Depreciation on this would be charged as, you can see here using the formula. So we will say depreciation is equal to original cost 2,20,000 minus scrap value is 20,000 divided by how many years? 5. So we will say 2,20,000 minus 20 is 2,00,000 divided by 5. So we will say it's 40,000 rupees per annum. When you are preparing your financial statement, profit and loss account, this is the amount which will be charged against the machine, and it will be taken as profit and loss account. Let's take an example of written down value method. In this, if you see here, it says a firm purchases a machinery for rupees 20,000 on 1st April 2010 and it is depreciated at 20%. So what we'll have to do is we'll have to end of the first annual year when we bought this, we are calculating 20% of 20,000, which is here. So 20% of 20,000 is 4,000 rupees. So first year, end of the year, that is 31st March 2011, the amount to be charged is 4,000. Now what happens the next year? Let's say 2011-12. What I'm going to do is 20,000 minus 4,000 because written down value. So cost of the machinery reduces. 20,000 minus 4,000, 16,000. On 16,000 we have to take 20% at the rate of 20%. So what is the amount? 3,200 is the depreciation amount which will be charged. Then what happens? Next year, 2012 and 13, we will not take the original cost, we'll take the written down value, that is 16,000 minus 3,200. This is the amount we are going to take. So we are going to take 16,000 minus 3,200. So I will write here 16,000 minus 3,200, which will give me 12,800. This is the written down value of the machinery for the third year, right? On this I am going to calculate 20%. So if I take it at 20%, the amount what is charged as depreciation is 2,560. So this is the amount which is taken as a depreciation in profit and loss account and in balance sheet. This is the entries we will be taking up in the next video. Now this is how it will go on and on and on till we get the zero. And if there is a scrap value, we will take that into account in the beginning itself. So this is how the written down value works. So with this, I'll be closing my today's video with the discussion on the type of depreciation, how it is charged. In next video, I'll be taking up how the entries are passed and we'll be doing some examples. Thank you, students. Don't forget to subscribe and like my channel. Thank you. Bye-bye.